And so my question for you this week, and I know this is a question that a lot of people have in the community because they'll either send me a message on Slack or Discord or, all the different channels that we have to communicate with students. And so I know that there are students in our community that have, whether it's an individual company or just the ETF like myself in the financials. So you and I were both away and we come back to this mess. So if you're looking at a covered call and you're managing a covered call in XLF, something has to be done at this point, right? We always talk about, covered call management is you've got to do something. So in a case like this, where support has obviously been broken, we've got volatility in this sector now. How would you manage a covered call to the downside?
Well, first of all, see, I trade the underbelly. I look at charts like this all the time. So, then the phrase I use underbelly are the DraftKings, the SoFis, the Palantirs, right? All these high beta Bitcoin, right?
Right.
So, I mean, this chart is run of the mill for me, right? But
Who
for
knew?
a lot of people, they see price action like this, and it's like they're not used to it, right? It is like really extremely volatile. And it comes down to rules for me, and it comes down to how you want to approach cash flow. Now, whenever I get a situation like this and someone's encountering this, I ask them a simple question. What is your entry price on this trading instrument? Because it plays into how I handle the situation. Because I don't want to take a loss. I don't want to panic, sell a covered call too aggressively that ends up, oh my goodness, this skyrocketed because the Fed pivoted, and now I'm taking a loss on the covered call, right?
Mhm.
So my question to you is, what is your entry price on XLF?
So the entry price was 35.
All right.
I've got a March contract that is obviously now worthless, and I've still got 17 days on it.
Mhm.
So my question is, do I stay in the same month and roll it up, or do I go out and go in the money and sell an in the money covered call?
All right. One principle that we want to do always is that we want theta to be working. We want theta to be working, and so the current covered call you have doesn't have any theta left in it, right?
Ain't got none.
It doesn't have any. So that is
There's
doing us
no more fee.
nothing
There's
to
no more.
mitigate against pain. And so first thing I'm going to do is I'm going to go out to April and see if I can pick up credit at 35. Now, I probably can't, but we're going to go check it out because, April, let's go April 21. Let's go those monthly options on April 21st. 38 days out, it's a reasonable price. I can
Mhm.
pick up a little bit. So now I'm going to look at these and I'm going to ask a second question to you, which is,
Mhm.
I've done this routine so many times at this point. What is your cost basis? Which is your cost basis is the entry price minus all of the covered calls you've ever sold again.
Correct.
Do you have an idea of how much credit you've gotten against those shares?
Uh, I've probably been doing this one for a couple of months, but not much. Let's just say I'm at break even.
Let's say, have you gotten $100 or
Yes. Yes,
all
I have.
all right, so that makes it all right. So our entry price was 35.
Mm-hmm.
Let's say I've sold $100 worth of credit, right? So that means my cost basis is my entry price minus the amount of credits I've received,
Right.
$100, which means my cost basis, what I'm into these shares for, is now no longer 35,
Mm-hmm.
it's 34. And so I
Correct.
can look out and I can make a really sensible, practical decision here without doing anything radical. I can
Mm-hmm.
look at the 34. It's a pretty decent credit for this type of instrument, right? It's a pretty decent credit. And so I'm immediately selling that credit. It's like, all right, let's get that in place because it's not a radical decision. I do not believe in radical decisions. Like it
Mm-hmm.
is like I don't believe in going and adding a bunch of bullish exposure any one day. I don't believe in adding a bunch of bearish exposure every day. I don't like, oh my gosh, this is going down. I got to sell a 32 covered call. that's a radical decision to me, because if this V-shaped, that would result in a loss. It would be like you've turned something you believed in,
Right.
something you wanted to own, something that you were willing to cash flow, and all of a sudden you're losing money on the way up of something you believe in. That's a radical decision, right? That's a radical decision. And so a real sensible decision here that's not radical is, right, all right, my cost basis is 34. I need to do something because, this is cucky, right? I need to mitigate damage. And so that 34 strike feels like a sensible decision to me. A covered call that would not result in a loss if, for whatever reason, XLF just skyrocketed, right? Fed pivots and this, and all of a sudden the XLF's at 35 again, right? And then we can go back and, well, what do we do at this point? Roll it out, pick up some credit, and so forth. But you do have to do something, right? You have to respect the volatility.
Yep.
Don't try to get overly cute, right? That has been a mistake for 14 months in this market.
Oh my gosh.
I'm going to wait for, no. You get credit working, right? Don't get overly cute. That's a reasonable credit at a strike price that isn't a radical decision, that follows a rule-based approach. And so I would buy back the previous covered call you have for $1 or $2 or whatever it costs, and sell that April 34. And then that gives you a little bit of time to reevaluate technicals, the macro situation along the go. So that's how I would handle that situation.
All right. I appreciate that, Coach Gino. Do you have anything you want to add to that?
No, that's a great way to put it, is, Mark said, what's your break even? What's your cost basis? One thing you have to decide when you get into a covered call is this an investment or a trade? In fact, every position you get into, the biggest mistake people make, especially option traders, they turn their plan into something different. They start weaving a bigger web. Well, maybe I'll hedge this. Maybe I'll do that. Maybe I'll do this. What's your plan from the get-go? This is an investment in like XLF, and you've sold calls against it for the last 5 years. You might have already paid this thing off. You don't want to pay taxes and dump it. You're getting dividends. It's cash flowing. So, and now if you just got in the position, you might consider a stop loss because you don't know where the bottom is on this news, right? So is it a trade? But if it's a trade, here, how do you know when it's a trade? When I'm looking at your portfolio, you have a stop loss, you have a target, and you have a time limit, how long you're in it. Anything that's going 3-4 months is not a trade, okay? And even good trades don't go that long, unless you're in something like, that just like a Bitcoin that did like the 6-month stretch, whatever. But here's the thing. Options would be too deep in the money if you're in a good trade for 6 months. You'd have to do something. So bottom line, is it a trade? If so, treat it like a trade. Where's your stop loss? Where's your exit point? How long you been in? If it's an investment, and that's why people get suckered into the call of the sirens of the covered call. Hey, I make money on time, and I make money if the stock goes up, and I'm protected the downside. But then they go, I'm losing after 3 months. What's going on? What if this goes bankrupt? Oh, shoot, I'm stuck. I don't want to sell that call below my break even. So I have a system where I call my DEFCON. What DEFCON are you in on this one? Is it DEFCON 1? I think we're DEFCON 1, because defense readiness, right? Defense readiness. First thing is this: get out. If you're scared, get out. You can always buy the shares back. Look on that chart and say, where would I buy these shares back at? So do that cover call with the highest extrinsic value right there in the money, at the money, to protect and get the most cash flow, because you need it. Who cares about your break even? You need money. Who's going to pay the most? The one with the most cash flow, short term. And if you're not getting out, buy insurance. Buy a spread to get you through March 22nd, because that's when the next interest rate is, right? Buy a little vertical spread. Buy a short-term put. Get a big chunk of cash flow in the short term in the money. Buy at the money protection with a short-term put to get you to March 22nd, because we're in DEFCON 1. We're talking about the bank failure. You know what I mean? This is a serious thing. So what DEFCON level are you at? Or is this like, it's just a seasonality thing? Cost average then. Cost average if you're not going to get out. My theory is this: if you're not brave enough to cost average and buy more shares, you probably should be getting out or putting in some protection.
I agree with that. There's no middle ground in this market.
No.
There's no middle ground. And the only thing I would say is if you're getting out now with a stop loss, you're doing things wrong. It should have been 5 days ago when
there you go.
Support. Mm-hmm. And these are things you're going to make mistakes, right? Everyone has to learn these things, right?
Yeah.
But don't panic sell after 6 massive days down, right? If you know you are going to get out, you need to have when support levels break, when you lose moving averages. 6 days ago would have been a great day, right? And just learn those, become disciplined, right? I mean, it is amazing what rules and discipline, how much easier they make trading, right?
Yeah.
But no, it is such, you should know when you get in whether it is a trade. This is great advice from Gino.
And that was a great question, by the way.
Use a stop loss, right? Use a stop loss, right? I personally don't use stop losses, but once again, my system isn't very well.
And there's simple option techniques. Like I had that question so many years, and I finally got a mentor. I'm like, here I am again with this covered call. Same question you just had. You're always going to get stuck in these bubbles because the bigger your account gets, the more positions you have, the more chance you pick one of these kind of guys, right? Like the more apples you pick, the better chance you're going to get a sour one. That's just how it is. But how do you deal with that sour apple? Did you set it up for a trade? This is where, like Mark started off with a great mentoring process where you go, okay, what's your situation? Where'd you buy it at? What's your plan? What's your outlook? You know what I mean? Because everybody's different how they manage it. And then he went from there. That's true mentoring right there. I like that. It's individualistic. And that's, again, what the labs and coaching are for. But also, a simple option technique. A lot of times I'll just neutralize my portfolio, buy an in-the-money put with no extrinsic value. And it's not going up in value. It's not going down in value. It gives me a few days, 3 days, 7 days, whatever, to think about it. At least I'm not making or losing money. I've got insurance.